So while Matt's getting wired up, I thought it was funny because Matt is a awesome venture capitalist who focuses a lot of his efforts on hardware. So I'm very flattered to be here as the quote-unquote first venture capitalist. But to anybody who's been to this before, you guys have had the pleasure of meeting also with an amazing venture capitalist with Matt. So thanks for having me.
Thank you. I think at that point we were supposed to say something about my hair and how amazing it looked.
Yeah, there was that, and then how good your shoes are and how lame mine are.
That didn't happen. Okay, all right. So let's start by a quick intro. So tell us about you, what you do, where you work.
Sure, I'll start with my background just because it's relevant to this audience, and then I'll tell you quickly about Flybridge. So my background is I spent 7.5 years in hardware before going to business school and then ending up in the investing world. The first 4 years, I helped start and run a consumer internet site in the hardware vertical. That site's called a non-tech. It's like CNET for geeks. If you've ever built a computer, you may have visited the site. We do about 20 million uniques. Still around, it's a small business that we've run as a lifestyle business. I left there to go to a company called ATI Technologies. ATI makes the chips inside the Xbox 360, Xbox One, PlayStation 4. And my products were called All-in-Wonder and TV Wonder products. So I sold product direct to consumer through Best Buy, Walmart, Amazon, and also through OEMs like Dell and HP. So I did that for 3.5 years on the product side, left there to go to business school, and I've been at Flybridge since. And Flybridge, very similar to FirstMark, we're an early stage venture capital firm based here in New York as well as in Boston. And because of my background, I spend probably about, this is maybe a little too much, about 80% of my time in hardware. So I spend a lot of time looking at hardware startups.
Okay, and so one of your first investments in the space was Dragon, right?
Yeah, that's right.
So Scott is our one sort of repeating presenter. He presented here twice.
He didn't bail out on the last minute.
No,
he got invited back.
Yeah, no, it's fantastic, by the way. Any context, your sort of investment thesis?
Yeah, so if people aren't familiar with Dragon, Dragon is a resource, a company that helps startups kind of go from prototype to manufacture in the hardware space. And the thesis there was really driven by the fact that one of our prior hardware portfolio companies, a company called Digital Lumens that makes high bay LED lighting, so connected lights for warehouses basically, used Dragon at the very early stages to help kind of initial design, but as well as factory selection and initial production. And the thesis was really, of the Dragon innovation investment, was really driven by the fact that hardware has changed a lot, and kind of the way hardware products and hardware companies go to market and get into production has changed a lot. And that if you believe that this trend is going to continue and that the hardware ecosystem is going to continue to grow, then you can paint a picture where the picks and shovels of that universe, whether it's a MakerBot to help do rapid prototyping, or Dragon to help you get into production, is a growing ecosystem. And so that's what motivated the investment in Dragon.
Okay, great. So I want to cover two kinds of topics. Yeah. One is sort of your general thoughts around the space, what you like, what you don't like, and the second part is fundraising strategies for hardware companies. So to start with the first bit, curious about where you want to play, which verticals you like, and is there a bend towards connected devices or hardware or 3D printing or anything you like?
Yeah, so we spend a lot of time, and I spend a lot of time kind of thinking about thesis in hardware, and I'd say that the thesis evolves over time, and so it's not, so hardware in general is a topic area that remains of interest, but kind of what in hardware that is interesting evolves as time passes and technologies evolve. So at the high level, I think the kind of the broadest theme that we are most excited about are hardware companies that have are hardware companies that deliver software, essentially. So the macro kind of trend is that, or the observation is that if you're a hardware company and you're making a widget, when I was at ATI, we made a lot of widgets, and those widgets would end up at Best Buy store shelves, and consumers would buy them for $300 or whatever it was, and they'd go off, they'd put it in their computer, and 3 years later, they'd come back to us when we had an amazing new model that was worthy of them upgrading, and they'd buy a new widget, and they'd put it in their computer. And so every 3 years, we had a chance to monetize that consumer. And those are fine businesses, but from a venture capital perspective, you're leaving a lot of kind of green on the table as far as potential monetization paths along the way. So what's more interesting to me are hardware startups that can continuously monetize the consumer through the life of the product. And the best example of this is Dropcam. It's kind of the software is the razor blade of hardware startups in that the Dropcam product itself made some money for them. So it wasn't sold at a loss. It made order of magnitude 30 to, when they were at scale, kind of 50 points margin when they sold the hardware product. And that was great, but that was a $150 to $199 product that they sold to consumers. And when you got it and you took it home, it did everything it said it was going to do on the box. It allowed you to watch streaming video from wherever you mounted it. You could access it from your phone or from your computer. It was exactly as advertised. But what they kind of hit on was they delivered the base product, but they made the incremental functionality delivered with a subscription service, which they charge anywhere from $9 to $5, depending on how long you sign up for. They made the product infinitely more valuable with the subscription service. And so they took that one-time 50-point or 30-point margin hardware product sale at $150, and they turned it into a customer that's worth, over the life of the customer, multiple years at $5 a month, which is a really valuable customer. And it is an observation that hardware companies that just sell just hardware and don't have that ongoing monetization piece are a lot harder to make valuable businesses. So that's one example of a hardware plus software play. The second kind of example there is hardware companies that are attempting to become software platform companies. And so the easiest kind of early example of this was the iPhone. Like, the iPhone is a great hardware device. Apple makes a ton of money selling a ton of iPhones. In case you missed it yesterday, I think it was like, they made like $1 billion a week in profit for the quarter, something absolutely ridiculous. But the exciting part from a hardware startup's perspective is that if you can get enough scale to become quote unquote a platform, which is no easy feat, but if you can get there, you can monetize everybody who participates on your platform. And so this is the play that, we'll see how it plays out, but this is absolutely the play that Pebble is going towards around selling a watch. So great, you can buy your Pebble, you put it on, you can charge $200 or $300 depending on what models you're going with. But over time, they have a vision of monetizing all the applications that are developed on top of the watch. And so that gives them the kind of ongoing revenue stream.
So interesting. So those are almost business models criteria as opposed to specific verticals, which is certainly a very interesting way of thinking about the world. In terms of verticals, though, whether you think of connected home or wearables or 3D printing or sort of back-end infrastructure, in any area that you like more than others?
Yeah, so I would say that we are generally fans of the quote-unquote connected home, broadly speaking. And I'm happy to go in more detail on any of these. Connected home, we are generally fans of enterprise sort of hardware deployments, which is kind of what Digital Lumens, that lighting company I mentioned before, is focused on. I'd say wearables were, certain aspects of wearables we're fans on, and a lot of that comes down to form factor. I think it's getting harder and harder to convince consumers and investors that you're going to be another watch or another strap that you put on your wrist, because you only have two wrists. And so at the end of the day, you're battling for wrist share, and battling against Apple for wrist share is not going to be easy. So maybe not as much wrist, but some wearable clothing-based or other sort of form factors are interesting. I'd say from like a 3D printing perspective, we are more skeptical, and the reason we're more skeptical there is because at the end of the day, we think that that 3D printing capability becomes over time a commodity, and it's a price play. And you've seen this, like this has played out. MakerBot started at whatever, $2,000 when their first version came out, and now I can get something that is almost as good for like $300 or $500, and that's going to keep going down. So that space we are more skeptical in.
Sure. And actually, I'm interested in a quick word on connected home, what you like, what you don't like. Obviously, that's the one area that's getting a lot of
connected home gets a lot of investment, a lot of attention from consumers as well. So I think that the magic in connected home happens when you can marry connected home plays with one of these software subscription models. And so the best example for me is actually a New York company called Canary that you guys may have heard of. I don't know if they've been at previous events, but
Yes, they have.
it's a home security product. So you put it in your home, it does home automation, kind of basic level stuff. Your lights are on, your smoke alarm's going off, stuff like that. But it does home security. And so you buy the product, but you pay on an ongoing basis if you want them to call the police when somebody breaks into your house. And so security, I think, is interesting, although becoming more and more crowded. And then I think there's this whole lighting automation piece. Nobody's figured out yet, at least in my opinion. And there's opportunity there. The question is, how do you implement and do so at a low cost? Because it can't be new build. So how do you retrofit and not have to touch every light socket or every light switch in order to automate?
Great. All right. So let's switch gears a little bit and talk about the funding process. All right. So we're a couple of founders. We have this great hardware product. Tomorrow Labs helped us, getting from an idea to something that's much more substantial. Then what? Do we go and raise a seed round? Do we, start a crowdfunding campaign? What do we do?
So let's assume that your product is going to be sold to consumers,
Yep.
and we can talk about non-consumer sold products after. But assuming your product is sold to consumers, there is 100% a trend into how these businesses are built. And I'm in the process of updating data here, but I have data from Q2 that I ran. The trend is this. The trend is raise a small amount of money, call it less than $1.5 million. Use that money to, and raise that from some seed funds, maybe friends and family, some angels. Use that to get to a crowdfunding campaign. Use the success from your crowdfunding campaign to catalyze a proper Series A that, if you look at the data, on average ranges from $8 to kind of $15 million in size. And that's the pattern that I've seen. Now that middle piece, which is the crowdfunding piece, is really critical to this, because if you raise 1.5 million or $1 million or $750, whatever, to get to your crowdfunding campaign, and your crowdfunding campaign does not do well, and does not do well does not mean sells, $2,000 worth of product. It actually means sells less than order of magnitude $300,000 of product. It gets really hard to go to that next level. But if your product does incredibly well, so let's say north of $1 million, and again, this is what the data suggests, if you do north of $1 million in pre-sales, that's the point at which you're unable to unlock, or you're able to unlock that kind of $8 to $15 million Series A round. So that's the pattern I've been seeing. Now, if you do a crowdfunding campaign and it sells, let's call it between $150,000 and $800,000, which a lot of campaigns do, I think that's a good indication of interest. And those people tend to put together rounds that are order of magnitude kind of $2 to $5 million in size. And so less money in the Series A for their next round, because they are not able to demonstrate as much consumer traction.
So 1 million is the magic number?
For me, and the data does support this, $1 million is kind of the quote-unquote magic number. North of $1 million, your success of raising a series, of raising a large Series A goes up meaningfully after $1 million in pre-sales.
What about venture debt? You see that appearing at, sometimes the seed stage, sometimes the Series A. Is that, the specificity of hardware is that you have an inventory component to it, and venture debt is, typically one of the ways of, addressing that. Any thoughts?
Yeah, so once you've pre-sold product, the venture debt guys out there are being really aggressive about giving term sheets and giving money to companies that have pre-sold inventory. So if you've done a campaign and you've brought in $3 million and it's going to cost you more than that, or it's going to cost you money to continue building, I see a lot of people successfully leverage venture debt to get to production. And I think it's a really smart thing to do.
What do you want to see in terms of teams? Or does it not matter?
No, it definitely matters. The teams that I get most excited about are specifically teams that have realized what they need to know in hardware and are not oblivious to it. And so that can be in the form of having somebody on the team who's done something in hardware before, or it can be in the form of having somebody like Tamara working with you, or somebody else as a very hands-on resource. Because the way you get burnt in this business is you think, in hardware specifically, is you kind of think it looks and acts like software, and when you go to try to ship, you're 9 months late to market because it doesn't look like like software when you're actually going into production. So I think that's an important aspect for me.
Yeah. So, last question from me. So, the whole concept of accelerator, whether that's RGA Labs, Techstars here, or Lemnos at West, makes sense. Is that something that that you like?
Yeah, I think it absolutely can add value. I think the right accelerators add more value than others, like some do. But in general, I like to see it because it helps make sure that the product has been at least scrutinized by some level of technical person on the hardware side who knows what they're doing enough to say this thing can or cannot be built. So I like seeing it, but by no means does it mean that it's a requirement, nor does it mean that just because you're in an accelerator, you're going to get funding. Because those stages actually stay the same as far as raise a little bit of money, do a pre-founding campaign, and then do your Series A after that. And kind of what those ranges look like don't change that much when you're an accelerator.
Great. Do we have questions?
Can you speak about the funding models in non-consumer businesses?
All right. So can you speak about business models in non-consumer business? I'm repeating the question so that it gets registered online.
Yeah, so funding models in non-consumer facing businesses are a little bit more tricky because they're not quite as formulaic. And I'd say on kind of what I tend to see doesn't look totally different. Where it looks most different is that crowdfunding piece. Because if you're not doing a consumer-facing thing, it doesn't make as much sense, obviously, to go crowdfunding. Where I do see people fill that gap is with kind of early customer stuff. And so that can come in the form of doing a seed round, getting some validation of interest from whoever your non-consumer customers are, so whoever your customers are, and using that to catalyze kind of the next round of financing. But it's not as formulaic in my mind as the consumer stuff.
Great. Do you have any other? Yes, if you could, I'll repeat it.
Can you speak a little bit about the regulatory clearances, especially like the FDA, UL, NSF, and when you should design towards that and also when you should be involved?
Yes, great question. Can you speak to the regulatory challenges, FDA and others?
So you mentioned a couple, and most of the ones I think you mentioned, so there's two types of regulatory when you're going into hardware. One is kind of the UL, CE, FCC sort of stuff, and truthfully that's pretty straightforward. You pay somebody money and they do that for you. The other things, which is your kind of question really focused on, which were around FDA stuff, is a really important thing to think about. And if you're building a product that requires FDA, any sort of FDA or some sort of clinical approval, you're going to want to think about your financing very differently, in that you are going to want to make sure that you can actually validate and substantiate the claims that you make in whatever campaign you do. And so what that I think means is that it means that you need to think about raising more money earlier in the company in order to start making sure that you have your T's crossed and I's dotted to go into that regulatory process. And it can be way more capital intensive.
At what stage do you get those people involved?
At what stage do you get those people involved?
I would say that as early as right before you, if you're doing a consumer-facing healthcare product, I would say as early as right before you're about ready to launch your campaign, because it takes a long time and it takes a lot of planning to do this stuff.
Great.
Hardware and other types of solutions that are consumer facing, that are more on the clinical side, rather than developing things for the sick, you develop things for the well?
So would you say that the regulatory issues are a major obstacle to developing consumer facing health products?
I mean, the answer is absolutely yes. And I know that I, as an investor, think about it very differently. So if you're making a Fitbit that tries to keep people in shape, you don't need FDA approval. And that is a wellness product that people, including myself, would have been happy to fund. Whereas if you told me you had to go through all, a year of FDA clinical trials and go through a whole bunch of 510K processes, I would think about the business very differently. So the quick answer is yes.
Great. Time for one last question over here.
Yeah, you mentioned the connected home as an area of interest. I was just wondering if you've seen anything in connected classrooms or anything else in the sort of education space.
But have you seen anything in the connected classroom or education space?
Not really. I've not really seen anything. Can I make one comment on the connected home?
Yes.
The one thing that I personally am much more skeptical of in the connected home is the concept of a hub. So my take on the hub, just as far as things that maybe aren't of our interest, my concept of the hub, I think that over time the hub goes away because I think everything moves to 802.11, and over time that you don't need this thing that translates your Zigbee and your 802.11 and your 900 megahertz and all the different frequencies into one sort of back channel to the internet. And so from a connected home perspective, I personally am more excited about things that are leveraging Wi-Fi or NFC, or rather not NFC, BTLE in the home in order to create a connected environment as opposed to a hub play.
Great. Thank you very much for being in and all those insights. You're going to be around for a little while? Oh, no, you need to leave. Okay.
I'm sorry, guys. I'm really easy to reach, though. I'm just matt@flybridge.com, or my Twitter's up there. You can tweet at me or whatever. But I really appreciate you having me back.
Wonderful. Thank you so much. This was great. Thank you.